A very good afternoon to everyone here today. I see some people still streaming in. Feel free to settle in. As Ricardo mentioned, I'm Daniel, and I'll be the moderator for today. I head the insurance department at the Monetary Authority of Singapore, and presently also leading the work on climate risk at the IAIS. Since I have the mic, I need to say a bit more about the work the IAIS has been doing. Just to give everyone an update. The challenge and the risk, I think, is very obvious. Just in the past year, wildfires and heat waves of unprecedented intensity have swept across Europe, North America, and Australia. And then you have record rainfalls in countries ranging from India to here in the States. I think that is it's real, and it's if we don't get a handle on this, it will just get worse. To promote a consistent global response, the CRSG was established in 2021 to support our members as they seek to better assess and address risks from climate change. Since then, we have undertaken a considerable amount of work, and I just want to give everyone an update. Firstly, on standards, to support members, the CRSG has embarked on a series of consultations on additional ICP guidance materials to incorporate climate risk into insurers' business operations and risk management practices. The first consultation paper, as many of you are aware, was published in March, and the consultation just closed in May, and we are going to dive deep into your feedback. 2 more consultations will be published in Q4, and hopefully by 1Q of next year for the 3rd one. Second, on scenario analysis, in the past year, we have held a series of capacity building workshops to educate and insurance supervisors on the use of climate scenario analysis. We are presently compiling all that material into an application paper. Hopefully, by the end of this year, we can issue that application paper for consultation. Finally, on data, to provide a global baseline of climate risk data and to pave the way for better assessment of climate risks, we have been incorporating for the last 3 years climate data elements into the IAIS's Global Monitoring Exercise, or GME for short. This year, we had requested optional data from insurers, and as I mentioned earlier during the dialogue this morning, the data from individual stakeholders like yourself have been very encouraging, and we hope to provide some good analysis in our report at the end of this year. Beyond all this work streams, we also engage other regulatory and standard setting bodies, whether it's the CIF, which I also happen to chair, or NGFS, the Basel Committee, and so on, because there needs to be a broad alignment of work done, less duplication, but more importantly, also alignment of regulatory approaches, which I hope will be good news for each of you as industry players. We have done some work, but frankly speaking, I think we've only we have not by any means scraped the bottom of the barrel here. There's a lot more that needs to be done, and why? In April, the IPCC warned that the current pace and scale of climate action is not enough to limit global temperatures to 1.5 degrees. Last month, the World Meteorological Organization updated that there is a 98% likelihood that for global temperatures in at least one of the next 5 years, and over the 5-year period, may be the warmest on record. These are really sobering statistics, and will have far-reaching repercussions for health, food security, the environment, water management. There will also be implications for financial stability. And today's forum, and I'll soon introduce our speakers today, help to give a better perspective on the implications for financial stability and how should insurers navigate and continue to navigate this landscape. Excuse me for that. Let me introduce the panelists here today. We are privileged to have representatives from both the private and public sectors to share their experiences and views on managing climate-related risks. So joining us virtually, we have Ramon Carrasco, who is the Group Chief Risk Officer of Mapfre. Earlier this month, Mapfre announced several climate-related achievements, which puts it well on its way to become carbon neutral by 2030. And I'm sure we'll be all keen to hear from Ramon's experience. Also joining us virtually is Lotz Mahlangeni, I hope I pronounced your name correctly, who is the Chief Actuary and Chief Risk Officer of Sanlam. Lotz joins us with a wealth of experience in the reinsurance, insurance, and investment banking sector. And joining us in person, to my immediate left, Ms. Marina Moretti. She's the Deputy Director in the Monetary and Capital Markets Department at the IMF. She oversees the policy and technical work on financial supervision and regulation, as well as on financial crisis preparedness and management. And further to my left, we have Dimitris Zafeiris. He's the head of the Risk and Financial Stability Department at EIOPA. Dimitris' experience as a regulator and his prior roles in the asset management industry will enrich today's discussion. So we do have a first poll, which I hope we can bring up to screen now. So you see the questions in the poll. So having heard that the current pace and scale of what has been done so far are insufficient to tackle climate change, how do you feel the medium and long-term risk to the insurance sector from climate? How has it changed given recent news, some of those statistics I've just highlighted? So feel free to enter your views into the poll. So why don't I just begin? So let's hear from our panelists. Maybe firstly, Marina. We know that climate change has far-reaching implications. So from a global perspective, what are some of these implications on financial stability? And what is the role that the IMF is playing in this space?
Thank you very much, and also for the very kind introduction. I think, and we have heard also this morning, it is no longer disputed that climate change has deep-seated impacts for human well-being and the economic performance, and that is also reflected in financial risks. And this can obviously have macroeconomic consequences as well as consequences on financial stability. One of the reasons for this, and I will elaborate further, is that it is not just at the level of the firm that economic losses translate into financial risk. But we have seen in a number of countries, particularly our members from smaller nations that are very exposed to climate change, that it can have very systemic economic and financial stability consequences. We're seeing cases of climate events and catastrophe that have, for example, wiped out most of the collateral base in the banking system. This is completely beyond doubt that these events have financial stability consequences and also extremely high cost for the government. Another example that I wanted to make, and it's more related to what we have heard about the protection gap, and we will hear more about this tomorrow. We see countries where the consequences of financial stability of climate change could lead to the entire withdrawal of entire sector of the industry from the country, particularly when these countries are reliant on foreign firms for the provision of financial services. And in a sense, this is a climate-related version of the many discussions that we had in past year about de-risking. It's a new sort of climate-related form of de-risking. Now, as we all know, the financial system is a vital component of all of our economies and play various roles to support economic growth through mobilization of savings, and the insurance sector is very important for this purpose, allocation of capital, facilitating trade and commerce, and providing financial services to individuals. One key aspect of it is that the financial sector is closely intertwined with the economy, with economic agents, both households and firms. And that's how economic losses of any size, and we see, given the trends that we just heard about the impact of climate change, these economic losses will increase and will increasingly translate in higher and higher financial risks and materialization of risk in the financial industry. Precisely because of the severity and increasing frequency of climate events. An additional point that I wanted to make is that it is not just a matter of the financial industry and the economy being obviously intertwined within a country. We're also more and more interconnected at the regional and international level. And so, impacts can translate and move through channels of contagions much faster than it used to be the case years ago. So we feel that the International Monetary Fund has a role to play in this space in supporting its membership. Macroeconomic and financial policy are an important component of the appropriate policy response to climate challenges. And these are areas where we at the IMF believe we have quite a bit of expertise. Let me say a few words about what we do in general, and then I'll dig a little bit deeper into what we do on financial sector issues. So we have broadly 4 types of activities that we conduct. One, obviously, is analytical research. We look at the macroeconomic consequences of climate change. And number 2, related to what we see as those macroeconomic implications. And again, we do believe that climate change is a macro-critical challenge. We strive to provide our member countries with policy advice in a number of areas, not just the financial sector, such as how to better monitor and incorporate climate-related risk into supervision and regulation, but also, for example, in the fiscal area, carbon taxes and the such. Specific to the financial sector, I would like to sort of say a few words about 2 products. One I just mentioned is capacity development or technical assistance, where we have 2 main lines of business. One is in the area of risk monitoring and helping countries assess the materiality of their exposure to risk at the systemic level, and if materiality is there, what we can say about impact potentially, as well as in the area of supervision and regulation, where we do support our membership incorporating climate risk into their prudential frameworks. A second key pillar of our work, our engagement on the financial sector with our member countries, is what we call surveillance, and more specifically, a program called the Financial Sector Assessment Program, which is a joint program with the World Bank for emerging markets and developing economies. It's just the IMF for advanced economies. And what we do in the context of the FSAP is go to countries, assess the strength and vulnerabilities of the financial system across all the sectors. And also, so that's the first pillar. The second pillar is to provide an assessment of the ability of the policy framework to handle safely those risks and mitigate those risks. And so over the past few years, we have worked quite hard in incorporating climate change aspects into the Financial Sector Assessment Program. We have expanded the assessment of climate risk as part of the vulnerability assessment. We do scenario analysis, drawing from the work that is being done at the IAIS as well as the NGFS. We also, again, as part of the assessment of the policy framework, look at the way in which countries have been able to incorporate climate-related risk into their potential framework and provide some advice in those areas where needed. I'll stop here.
Yeah, thanks, Marina. Singapore just was paid a visit by the IMF for our annual Article 4, and I can assure you all those questions were asked. So I'll just, maybe to Dimitris, apart from the IPCC report in April, there have been other reports citing that the global community, we are unfortunately failing to deliver on agreements to hold climate change below 1.5. So what does this mean for the risk insurers face?
Thanks. Perhaps I'll try to build on the comments from Marina, focusing on the insurance sector in general and Europe in particular, perhaps. Now, conventional wisdom suggests that with global warming, we expect an increased, let's say, frequency or changes in frequency and severity of NatCat events. And perhaps more extreme NatCat events will become, or tail events will become part of the new normal. Obviously, the sector that at the core of its business model is providing financial security, financial guarantees, and protection against such events is, let's say, at the front row of being impacted negatively of such developments. What have we done at the EIOPA side? We try to assess all elements of this impact, and directly from the physical side, physical risk, or as we say, the product side of the sector, but also transition risk. Let me start perhaps mentioning what we've done on physical risk. We published a report, I think it was last year, in terms of exposure. That was our first step. We tried to see where the exposure of the sector stands today. We show that the number one exposure stands at the windstorm coverage, which is in the area of 40 trillion euros, followed by river flood, approximately 30 trillion, and then wildfire and coastal flood, 20 and 10 trillions respectively. Now, although when looking at windstorm, the link between climate change and windstorm is not directly there, or it is not directly clear, the rest of the perils, the rest of the risks, like river flood, wildfire, and coastal flood, is expected to be influenced by deteriorating climate environment. And as such, we do expect the impact on the sector to be quite significant. What could we do about it? Well, one of the paths one could follow is try to see what would be the impact. We had an additional analysis there. We published it end of last year in our financial stability report, trying to see within a 2-degree scenario, what would be the impact on the sector, and again, based on the exposures as they stand per business line and geographically. One would easily observe that, let's say, the most significant impact was on temperature-related hazards, which are expected to increase significantly, especially in the southern part of the continent, but also at the same time across Europe, central and northern, climate change on water-related drivers is expected to be quite significant. Now, this is as we assume that there is no action taken. So, let's say climate risk deteriorating, global warming, etc. One would say that there may be some action at the policy side, but the risk here is what if this action is delayed? What if it's a last moment action? And this is what we try to assess by looking at the transition risk scenarios. Delayed transition is the most extreme one, so focusing on the asset side. Another analysis we did there, main conclusions, especially on the equity side, you may observe let's say, loss of value in the area of 20%, followed by still lower, but still double-digit impact on corporate bonds, less, of course, when we look at other types of assets. Of course, when you look at the total impact on assets and liabilities, the impact is much smaller. But then one would wonder, do we look differently at the impact on liabilities and on assets, or could we also assume or expect or fear a scenario where, and there is a delayed transition, and there is already more, let's say, significant impact on the liability side due to physical risk. Now, one could argue and say that this type of contracts, when looking at non-life contract, they are short-term in nature, 1 year. So if the sector sees that things are going south, things are going in unfavorable directions, they may take action. And for example, the risk, they may sometimes perhaps step back from specific products, increase premiums, etc. We have examples of that. We have examples, I think a recent example here in the US was the State Farm ceasing to accept applications for, let's say, wildfire risks in California. Similar examples we have in Europe, of course. And here we enter what we call the protection gap paradox. Why a paradox? Because at one side, looking at a purely prudential and perhaps immediate risk side, you can say you decrease the exposure in a specific area, hence you decrease the capital risk or the solvency risk of the sector. Nonetheless, When you're doing this, you increase what we call protection gap. And this matters. It matters not only for the public, not only for people, but it also matters for the sector itself as an increasing protection gap. Let's take a note here that according to the EIOPA protection gap dashboard, only 25% of NatCat related losses are currently insured. One can expect that if this deteriorates, even a larger portion of losses will be uninsured, unsecured, and this will have great implications also on the macro side, on the fiscal side. So it will in turn cause, let's say, instability, will have an impact on financial stability, and hence perhaps not directly, but indirectly and a bit in the longer run, will again influence the sectors, because you cannot expect the financial sector to be stable in an unstable financial environment. So all in all, I may conclude by that, let's say, a delay or failure to act promptly will have significant impact on the sector and all parts of the balance sheet.
Yeah, thanks. Because, I mean, for those out there who still have some skepticism as to whether climate change can have financial stability implications, I think you've heard from our first two speakers, it's real. Maybe you can quickly pull up the results of the poll. As you can see, all of you feel that most of you feel that it's increasing, large majority. And maybe then to Ramon, you've seen the poll results from the audience. So what do you think of the poll results? Is your particular firm and business feeling the impact of climate change, and in particular, what business lines or geographies do you feel it's being greatly impacted?
Hi, thank you. Well, first of all, I would like to thank the IAIS for the opportunity to participate in the panel. Unfortunately, I am not able to be there in Seattle. I hope you have a very productive days and that you enjoy the city a lot. On the outcome of the survey, it's not a surprise. In recent years, the insurance industry has been affected by a large number of events that were difficult to anticipate. We have the COVID pandemic, it has been followed by a war in Europe that has caused major impacts on financial markets, inflation not seen in 40 years, and a sharp increase in interest rates that will affect the productive capacities of countries. Climate-related catastrophes have not been left behind, and we have seen an increase in the frequency of these events that were widely distributed among different geographies. But the distinction between a climate event and a climate change event is not easy. It's not easy in the case of a catastrophic events, and even less in lines of business such as health or life. In fact, the industry was born to insure weather events. However, the risk of climate change is the risk derived from the long-term change in the average weather patterns that have shaped the local, regional, and global climates of the Earth. This risk will be seen mainly as an increase in extreme weather events, such as subtropical cyclones, floods, or forest fires. But these events were already included as climate events. Climate risk has a short-term perspective that refers to the probability of losses generally within a one-year perspective due to climate events compared to the estimates. On the other side, the risk of climate change is a very long risk of loss, and therefore the uncertainties are much greater. In any case, climatic events are taking place, and 2022 was a relatively benign hurricane season, but it picked up one of the greatest droughts in the Paraná River Basin in southern Brazil and Paraguay this year. We have started with several earthquakes in Turkey that, although they are not directly related to climate change in principle, they are important, have important consequences for the coverage of natural catastrophes as well. Regarding the future perspective, the different physical information portals based on the commonly applied scenarios of climate change anticipate an increase in the occurrence of these events. Although consistent information is not always obtained between the different portals, the way in which it materializes will be key. If this increase occurs in a linear manner, insurance will be able to increase premiums to cover an increase in claims. If it is abroad in a more volatile way, it will be much more difficult. These situations will cause continuous monitoring by insurance companies of climate events, and where appropriate, measures must be adopted regarding premiums, policy conditions, coverage limits, and even on the insurability of certain markets. Therefore, if there is going to be an increase in the frequency of climate events, it should be monitored by the insurance industry. We can't clearly anticipate the geographical areas or perils that will be most effective in 30, 40, 50 years, but there could probably be a concentration of these activities, and this concentration may mean that the private sector, that the private insurance sector does not have sufficient capacity to cover these increases in frequency of the events, and so the capacity of these areas may be reduced. In this situation, it is especially important to find ways of public-private collaboration that guarantee minimum coverage in those areas. And this leads to the debate that Dimitris already anticipated on protection gap.
Thanks, Ramon. How about Lotz? Do you agree or disagree with Ramon's comments?
Good evening. I know it's the afternoon in Seattle. Thank you very much for the opportunity to join your conference. I unfortunately also couldn't be able to attend in person, but I'm grateful that I could at least join you virtually. I think I agree with everything that Ramon has indicated. I mean, it is a complex problem, the whole issue of the climate change and the impact that it has on the P&C business. Sanlam underwrites both P&C as well as life insurance business. So in terms of taking a forward-looking long-term view on risks, I mean, we underwrite longevity risk, where we have to determine whether mortality improvements are going to occur 20, 30, or 40 years from now. So we have been used to situations where we have had to take a long-term view. And I think we take a similar view when it comes to the issues around the climate change. But just to give you some perspective, I mean, we are in the southern tip of Africa, and Sanlam is an emerging markets insurer with operations in the rest of the African continent as well as in India. We've seen an increasing frequency and severity of climate-related events. Last year, in the eastern part of the country, we had the largest net cat event, where there was floods that led to losses of approximately $2 billion, and it is the largest net cat event in South Africa's history. And prior to that, we've had an extended period of drought, which causes a lot of disruption, particularly for food security and value chains. And we've also had some wildfires as well that have led to large claims. So the impact of climate change is real in terms of the impact it has on the business. But for a developing economy like ourselves, it's got further disruption in terms of not just financial stability, but also potential social instability. Because you're disrupting value chains, you're disrupting supply chains, you're disrupting development, and therefore, you're also disrupting the socioeconomic impacts in the country. Now, if you ask, okay, so I mean, what do we expect is going to happen going forward? I mean, we do believe that the role that insurance plays, I mean, my colleagues have referred to the protection gap, but the role that insurance plays in facilitating economic activity and the allocation of resources continues to be critical. But in a situation where the cost of risk is increasing, and for a developing country, it's even more severe because it can, set development back a few years. We've also seen in the recent past that not only, are you getting this increase in the severity of events, but you're getting an increase in the cost of reinsurance. So some of the reinsurance renewals that we've had to undertake have led to significant costs, which means that the cost of doing business does increase. But on a forward-looking view, I mean, we've taken views on other pandemics in the past. I mean, in South Africa, we had to contend with the HIV/AIDS pandemic, and we had to build capability to be able to model that from scratch. And we're also doing something along the same lines in terms of determining, the evolution of the future climatic events. It is complex because a complex adaptive system, because you've got the interaction between the mitigation and the adaptation, and also the fact that it is an unpredictable situation. So I think in terms of how it evolves going forward, it requires a regular and constant monitoring, as Ramon has indicated. But we've been fortunate in South Africa because our regulator has taken an extremely positive and proactive stance in terms of engaging with the industry and capacitating the industry in terms of dealing with the issue. So we are concerned that the situation will evolve. It will get worse before it gets better. But we do believe that with the right interaction between the industry and the regulator, as well as the actuarial profession, will be able to contend with it going forward.
Yeah, thanks, Lotz. It's really good to hear in South Africa your regulator is being very proactive and working with the industry. So to the audience here, we have heard the wide-ranging implications of climate risks on financial stability and, of course, also on the balance sheets of insurers. So the question really is, how do we go about addressing them? And what role does the insurance supervisor play? And we've already heard a preview from Lotz. So before we jump into this question for our panelists, the second poll is now open. So what are the impediments to effectively pricing in climate risk on the insurer's balance sheet? And you have a number of multiple choice questions there, and please take your time to fill it in. Lotz, you were the last, and now I'll make you the first. So the poll question mentions impediments. This includes data unavailability and maybe some improvements needed in modeling and valuation tools. So as an actuary, how do you tackle such challenges? What further steps do you need to take to understand the financial impact of climate risk?
Yeah, I mean, I think when you're dealing with novel problems, similar like we had to deal with the COVID, you start with no data, but you still need to make decisions and take action. So, the principle there is you build the capacity as you progress. So I think with dealing with the climate change situation, I think there's a lot of work that's being done in developing modeling capabilities and gathering data. And in a situation where we're all trying to deal with a complex system problem, the collaboration that takes place in terms of sharing the data capabilities, the modeling capabilities, and also having an anchor in terms of the profession, and developing the capabilities. You had during COVID a whole lot of professional bodies, actuarial bodies, sharing information, gathering data, gathering capabilities, and that was able to develop some capabilities to be able to forecast and determine what the impacts are going to be. So with climate, our regulator has set up a task team and capacitated with individuals to be able to determine, what kind of data needs to be required and to coordinate for the industry. Internally in our company, we've set up capabilities where we're slowly gathering data. We do a P&C insurance, so we've got a lot of data from a geocoding perspective, for example. And so we've been able to use that data. So I think it's a journey, but it's a journey that must be defined by the fact that it is a novel problem, and you're not going to be able to get all the answers. But as you progress, you'll be able to develop capability, and collaboration is key. What is important is a fast learning process, and to be able to adapt the knowledge as it evolves. And, with all the P&C insurers, they've got access to a whole range of experts, whether it's, geocoding experts, and climatologists, data scientists, and actuaries and statisticians. And it's a question of getting all those capabilities together, and to be able to harness all the different strengths of the different capabilities to be able to build the system to be able to do the modeling. What we have been able to look at is the scenarios in terms of the financial implications. So, I mean, as all insurers have to undertake very extensive processes relating to their own risk and solvency assessment. And so when you conduct that exercise and you are able to determine and stress test your balance sheet, you're able to look at certain situations and you're able to model some climate conditions and some extreme climatic events and be able to determine the impact they will have on your earnings, for example, your liquidity positions, your investments, as well as your capital position. And that also tool as a framework, but then supplemented with specific modeling capabilities, particularly to address the climate conditions. It's a very useful framework to be able to understand what the exposures are and what the financial implications are.
And Ramon, in your role as Chief Risk Officer, I'm sure you'll be facing very similar risk management challenges as what Lotz just highlighted. So in particular, what are some of the tools that your firm and others can use to better understand the financial impact of climate risk?
Well, I very much agree with Lotz. This is another emerging risk, and there are many emerging risks on the table. We have artificial intelligence, geopolitics, agents. There are many of them that we have to consider. I was a bit surprised by the question in the poll. I have no reasons to point out that climate change, climate risk is not priced effectively on the balance sheet right now. I think the work of the actuaries are very hard on this, and they are taking all the information that needed. They are taking current data. They are including what the trend could be in the future. So I think the role that actuaries are doing on valuing technical provisions are very important, and they are changing a lot and taking a lot of work on this. On the valuations of the assets, are more or less the same. I think making adjustments to market valuations, it could be biased. And I don't know whether the valuation that we could get will be better or worse than the one that the market is given. And another different thing is in the design of very long-term scenarios relating to climate change. Here, of course, we do find many of the problems that are indicated in the question, and it is clear there's a lack of data, and there are a lot of difficulties in translating physical risk into economic losses due to an increase in claims, and it's difficult, and it's very difficult to capture it in the models. In terms of these scenario modeling, a lot of very useful work has been done already in relation to how physical variables can change in different scenarios, but it is difficult to translate this into a loss. For example, if the scenarios are predicting a change in a variable of maximum daily precipitation, what will be the impact in flooding, what will be the impact in property damage, is very difficult to quantify. We must continue, of course, working in this line. I think we're working well, and we are progressing a lot in the recent years. I think it will be good, of course, if there were some standardized scenarios, modeling applied by the insurance industry, which could be taken into account when comparing the situation of different entities. The supervisors have done a very good job on this, and when it comes to defining these different scenarios. Of course, this does not mean that the insurance industry and the companies should not develop their own scenarios that better suit the reality in order to find how their business could be affected or what are the business opportunities derived from the scenarios. In the definition of these scenarios, I see that there are still a lot of difficulties to overcome, how to consider the evolution of the insurance throughout these large numbers of years. Should it be considered that insurance does not adjust the premium to the continuous increase in claims, or that the portfolio of the assets and liabilities does not change in 30 years? Climate change also poses risks, but also give a lot of opportunities. But how should these opportunities be considered in the scenarios? For example, it is clear that there will be winners and losers in the transition. However, in most of the asset transition scenario, it is common to calibrate that all the sectors lose. Is this correct? The map of evolution of physical variables from different portals, although very useful, can give results that are inconsistent with each other. So how to select the best risk maps and the best physical variables that could affect the loss of the undertaking. Although the definition of these scenarios can be improved, that does not mean that they are not useful even today. You cannot quantify risk with the scenario because you don't know the probabilities, but they are still very useful. They are useful to analyze the perils that could most affect each country, and they are useful to analyze the current accumulations that the company has on those risks, on those regions, to determine the catastrophic capacity of each of the territory and limits in case of excessive exposure, control the evolution of future of these exposures. These measures, anyway, are not different to those that are currently applied in the management of natural disasters, whether they come from climate change or not. But above all, to know the risk well, to understand them well, it is necessary, of course, to have data. Dimitris already referred that there is a natural catastrophe gap in Europe of 75%. This means that insurance only have 20% of the necessary data. In other markets, this percentage is even lower, and we must be able to obtain this data and make it available to the insurance sector and public institutions in order to make more informed decisions in this transition. And what we all want is to transition, and the more data that we have, it will be better for the society as a whole.
Thank you, Ramon. Risk and opportunities. So I think that's the incentive, even in as we move along on to deal with climate change. If we can pull up the response and the results from the second poll. So it's a pretty mixed picture, and in a way, all of this quite apply. So thank you for your responses. Just maybe I'll turn to Dimitris. As an insurance supervisor, and you've heard from some of these industry players, how do you support insurers in their efforts to manage such risks? And in particular, you could give a bit of an insight into developments in Europe as you get your licensed insurers to formulate a better picture of their climate risk management.
Yeah, thanks, Daniel. Indeed, we heard some of the concerns, some of the challenges. We see also in the results of this Slido that they're not concentrated, right? So it's not one problem. There are many challenges. On the information side, you see we may be missing information, granular information on the asset side to see what sectors am I exposed to, how green or not green this sector is. So these challenges are there. On the liability, on the product side, can I model properly if most of the models are based on past information, and how relevant is past information in an environment that the climate is changing? Also, another thing that we need to let's say, face is this perception that climate risk is a slow risk, is a long-term risk. It's not going to happen in my watch. Well, indeed, one would say that the impact, the immediate impact, is not going to happen if it happens as quick as, for example, liquidity risk that in a bank may happen tomorrow and may lead to challenges within a weekend. But there is one peculiarity. Maybe the impact will be, let's say, visible and will come in the more long run. However, the chance to mitigate the risk, the chance to ask, will not be there anymore. So you need to act now to mitigate the risk that will come in the future, which is different than other types of risks that, well, in the liquidity risk, as I said, you may be able to act while it happens. In the climate, this will not be the case. So this long-term perception is actually quite false and quite risky, because at that time, you will not be able to act. So what do we do about it? Well, there are many fronts, many, let's say, initiatives at the European side. I'll try to focus mainly to something, 3 of them, trying to touch about in different areas. One would be on the perception and on the risk management within firms, within the sector. We issued an opinion a couple of years ago suggesting that insurers, in their own risk management assessment, in the ORSA, they should include climate risk, they should include the assessment of climate risk, both in the short term and in the long term for institutions that they have. We understand that it is challenging, especially when it comes to the long term. A lot of assumptions need to be made. There was also then an application paper. How do you do this issue at that time? Trying to cater also about the fact that you should do also some scenario analysis if you have significant exposures, at least for the most relevant institutions. And there is this expectation from the private sector that they do need to look into this matter seriously, because what we did observe from various surveys is that not all the sector was giving priority to this changing environment, to climate risk. Another element that one would look into, trying to bring from the supervisory perspective, is the prudential element. So do current, let's say, and talking about Solvency II, that it is a forward-looking regime. Do you cater for the current risks, the different perhaps risk-return characteristics as they formulate now? Is the current environment, the current framework sufficient? We issued actually a discussion paper at the end of the year. We are currently in the consultation process, collecting feedback. We try to see whether, let's say, the framework is addressing correctly the risk weights on assets, on exposures when it comes to transition risk, also on the underwriting risks and climate change adaptation, but also changing, touching about topics such as social risks and objectives. Now, I'm not going to preempt the outcome of this. It's currently under process, and we expect to see how this one will end. Finally, another area that deserves visibility is the impact, is the vulnerability assessment. It's good to know how things may develop in the financial sector. For this one, I'll bring an example of something that is in the pipeline, will happen. We don't have the publication yet. Actually, it stems from the recognition that, looking again in the European context, that the transition to a green economy will require significant amounts of investment. If I recall correctly, the amount, it's an excess of 350 billion per year. This cannot obviously be covered only by public funds, so the private sector needs to be involved, and private and the industry, the real economy, but also the financial sector to facilitate that. So under the request of the Commission, to all the ESAs, so ESAs in Europe meaning insurance sector, banking sector, and the markets, in cooperation with the ESRB and the ECB, we were tasked to make what we call a one-off exercise, a cross-sectorial exercise, applying common scenario, two, I think we're going to end up scenarios that it's going to be applied through all the sectors, also taking into consideration what we call second round effects, and try to see what would be the impact in unfavorable developments, and in what condition is the financial sector to be able to be part of this transition into a more green economy. So all in all, a lot of open fronts and significant efforts, and from the regulatory side, but also from the industry is expected.
Yeah, indeed. So we have heard from Dimitris about the role a leading insurance supervisor like EIOPA has played to raise awareness and also to better measure and get a handle of the climate risk, at least in the EU region. So given the important stewardship role of the insurance sector in the broader economy's transition towards net zero, one fundamental question is, what do we think of the role of insurance supervisors in supporting the broader transition towards net zero? We, at the IAIS side, we posed a similar question in our recent first consultation paper. Responses were quite varied. There were those who were extremely enthusiastic for insurance supervisors to do more in this space, and there were some who are still raising some skeptical views. So these are the issues that I hope to explore in this next segment. So if you can pull up the third poll. So what role can transition plans play in the insurance sector? Frankly, no role, or map up a path towards transitioning as a stakeholder communication tool, and so on. So please help to fill in your views on this. I'll turn to Marina. So The traditional mandate of supervisors relates to policyholder protection and financial stability. To what extent will you advise that transition plans be included or encouraged at least in prudential supervision frameworks? What is the IMF's work around assessing and quantifying risks, such risks in the financial system?
So let me start by saying that just looking at the attention that is being paid in this space by, obviously the IAIS, but also the NGFS that just came out with a paper just last month on transition planning. There is growing agreement across policymakers that prudential transition plans can play a role, a crucial role in climate risk supervision, and this is on top, the transition plans that guide firms in their sort of business strategy as well as their own risk management. Prudential transition plans informed by the broader climate policy objectives of governments such as net zero targets as well as nationally determined sectoral pathways can be useful in steering various components of governance risk management and framework where climate consideration need to be incorporated from both a supervisory and a risk management firm level perspective. One useful aspect, a particularly useful aspect of transition planning is that it is inherently forward-looking and so can address some critical challenges of the way we typically, as supervisor, look at risk management issues, which is the time horizon, obviously, as well as the fact that the modeling tend to be backward-looking, and in this case, the data is a major issue. And finally, we think that these prudential transition plans can also be helpful in facilitating cross-border cooperation among supervisors. Having said that, there clearly are a number of challenges in including transition plans in the prudential framework. The first clearly is mandates, the different mandates of different insurance supervisory authorities and the degree to which, depending on the countries, those mandates can accommodate, facilitate a transition to a low carbon economy. The second one is that, looking across the world, different governments are at different stages in determining their own broader climate policies, net zero targets, as well as transition pathways. And of course, those are necessary precondition for the supervisor to think about prudential transition plans because, obviously the supervisor by itself cannot be expected to drive the transition to net zero. There are a number of challenges also, but that we believe that these are issues that can be covered through more thinking in the industry and in the regulatory community and more guidance. These include the issue of defining transition plans. There are different types of transition plans. Clarity on definition, clarity on the data and the information that needs to be included would really help. Certainly the industry, but also across supervisors to have a common understanding of what it is that we're talking about. The other one, which is related to what I just said about different stages of government in climate policies, is how best to align entity-specific transition plans to national transition pathways and then to the work of the supervisor in this space. There are further challenges, I think, in emerging market and developing economies that, for example, one general point that has been made also this morning by our colleague at the World Bank in his opening remarks is, resources for the supervisor is a critical challenge across sectors, across topics, and of course, this has been exacerbated by the need to, incorporate climate consideration. It is also that in some of these countries there are a variety of challenges to be competing challenges, including social ones, and these compete with limited resources. And I would also like to mention there are cross-border challenges. For example, the difficulty for cross-border insurance firms and conglomerates to operate in a cross-border environment to develop enterprise wise transition plan, and not least the implication for some emerging market and developing economies of transition planning by home firms if they were to be applied at the group level. So lots of challenges, lots of work ahead. We do believe that prudential transition plans are a promising approach. We have been working with not just the IAIS, but the NGFS on their work in this space. We will continue to do so. Just to mention that we believe it is important in parallel to continue to work on just incorporating climate-related risk in the prudential framework, which we believe it is important. It needs to be anchored in the existing safety and soundness mandates of supervisors. It needs to be commensurate, given scarce resources, with the level and nature of the risk faced by institutions. And it needs to be supporting transparency, including disclosure, and consistency across institution and sector. And there is work here as well. Very last point, we work across the world, and we do a lot of, we have a lot of capacity development engagement with the industry, with emerging market and developing country supervisor in the insurance sector. I think it is fair to say that stress testing and methodology in advanced economy is where the work is happening, and there is a lot of learning and it's a lot of activities. What we see in terms of what the supervisory authority are doing in some, or at least some of those countries, it is much less advanced. We put a lot of effort into awareness building, and again, the issue of resourcing is a major constraint that will need to be addressed. I'll stop here.
Those are really very good points. So at least from Marina's sharing, one of the takeaways is that some form of supervisory guidance on transition plans can provide some more regulatory clarity, hopefully more alignment and standardization. Maybe I'll hear from the poll and from all of you, if you can pull out the results. Okay, so it's quite clear. Only a very small minority think that there is no need probably for guidance, but certainly transition plans are important and useful tool moving forward. So you've heard from Marina, let's hear from Ramon and Lotz. Ramon first. So hearing from Marina and hearing from the audience here in Seattle, should supervisors issue guidance on the development of transition plans or in transition planning? As an insurer, what kind of guidance will help you?
Yes, excuse me, I haven't seen the outcome of the poll. Anyway, I think that, of course, the insurance sector is key to facilitating the transition both from this perspective as an investor and as an underwriting risk. For this reason, the development of transitional plans in insurance companies is an important aspect within the strategy, as is the setting of objectives relating to sustainability criteria. Taking this into account, there will be entities that could focus on the E, that could focus more on the environment, others put more effort on social parts, others on the governance part. I think all of them are very important. Of course, we need to take care on the E, on the specific objectives, and it's very important on climate change, on biodiversity, and many other objectives, but they are not alone. The role of the supervisor in the design of the transition strategy is really not clear to me, which I believe is the decision of the entity, is part of the decision of where the entity wants to go and how to do it. In any case, in relation to the follow-up of these plans, I would like them to be based on a constructive approach and to encourage companies to make more and more commitments. We must be very careful in introducing the wrong incentives. An example are capital charges for investments or underwriting in carbon-intensive sectors, which are those most important when it comes to moving towards to a carbon-free economy. They need to finance the transition, and regulation should not make it more difficult. I believe that very restrictive interpretations, very active interpretations in terms of sustainability that creates administrative burdens could also not help the entities to move to the transition. And the final goal is moving to the transition. Any effort in the transition should be welcome. We must create a framework that encourages companies to set demanding goals rather than no goals at all. Another different thing is in the design of long-term climate change scenario. When analyzing the transition risk of an asset of a specific company, it should be taken into account if that company has transition plans that reduce the transition risk in that company. In short, we must look for incentives that make us advance in the transition, but are not discouraging to move to the transition.
Thank you. For Lotz, what's your perspective? Because as Sanlam, you operate obviously on the African continent, but also you have operations in Malaysia and India, all very different jurisdictions. So, and all going through different paces of transition towards net zero. So how would any kind of supervisory guidance on transition planning, will it be useful to further your firm's sustainability goals?
Yeah, I think, Daniel, we do operate in a complex environment, but we think that there's a role for the supervisor to play in terms of providing guidance, but it must be very controlled. It must be principles-based rather than detailed guidance, because we are dealing with a very nuanced situation. We do operate in different jurisdictions and with different, paces of transition or different stages. And I think, the pace of the transition that you're experiencing and also how the various jurisdictions are dealing with it can introduce some risks. So would want the supervisors to get involved in such a way to bring a bit more order and structure to the situation rather than to introduce a new risk. I fully agree with Ramon's points around the issue of potentially introducing the wrong incentives. I think the supervisors can play a role in ensuring that there are consistent frameworks in terms of how the companies think about their transitions. But also, I think I haven't seen the results of the poll, but the issue around the stakeholder communication, regardless of the jurisdiction you are in. I mean, we did spend a bit of time earlier on talking about, the losses that we are experiencing, perhaps on the underwriting side. What is also important, we're also asset gatherers, so we're doing quite a lot of gathering of assets from a savings perspective, and also secondly, we have investors that supply us with capital that we have to be accountable to as well. So a supervisory approach that enables all the suppliers of capital to be able to evaluate on a consistent basis across all the different players in terms of what their plans are, would bring a bit more order and ensure that some of the transition risks are mitigated. So I think, in my view, I think any intervention or any engagement by the supervisor needs to be on a risk-based view, but it also needs to be principles-based, and it must ensure that it doesn't encroach in terms of the decision rights that the various institutions have in terms of determining what actions they want to take.
Perspectives. Thank you for sharing your perspectives. So we've heard from our panelists over the last 45 minutes or so on the implications of climate change, especially financial stability implications, steps taken, whether at a firm level or at the global or even regional level, to address climate-related risks, and of course everyone's view so far on transition planning and related supervisory guidance. We have a couple of minutes left, and I just want to open the floor up for open mic questions. So are there any questions that anyone will want to ask? And maybe if you can introduce yourself briefly before giving up your question. The lady over there.
Thank you very much. Mariam Golnari, I lead the climate change and environment work at the Geneva Association. I have two questions, if I may. One on the rising protection gap. So the insurance industry and insurance regulators actually work within an ecosystem of stakeholders that create the risk and manage the risk. In other words, while climate change may lead to the rising risk of, hazards, but let's not forget the vulnerability and exposure part, the fact that we have moved more people and more assets into the high-risk regions. So as we talk about this rising protection gap, we need to incentivize risk reduction and risk prevention. And we need to work within a system-based, because we are not the only one that create or reduce the risk. There is the government, there is private sector, people and residents themselves can take measures. So my first question is, what is the role of insurance regulators in promoting a risk-based, system-based approach to risk reduction and risk prevention to actually keep insurance viable and not priced out of the market? That's my first question. The second question is what Ramon said about transition. I just don't want it to get missed out. I want to translate this discussion of transition from net zero plans to actually what's happening on the ground. Very recently, many jurisdictions passed industrial decarbonization laws with significant subsidies to support that. United States, EU, Japan, Canada, and a few more. So the issue here is, over the course of the next decade, many new technologies are going to hit the ground to enable that industrial decarbonization. They're going to need insurance, they're going to need massive financing. So what is the role of insurance regulators to enable this critical catalytic industry to be able to play its role? One, as underwriters, two, as investors. Thank you very much.
Thank you. On the protection gap question, maybe I can let Dimitris, you take a shot at that. Because it's pointedly at us, insurance regulators. And then, then maybe I can pitch in on the second question as well.
Yeah. On the first one, I agree with most of what you mentioned. What is important here to say is that there are multiple stakeholders involved, so it's not easy to say what should regulators or what should industry do. I think it's important that it's also the governments, so there is, let's say, a wide range of, and definitely also the policyholders. I think we have to go into a system that everyone has skin in the game. So there is the risk sharing also between these different stakeholders. It must not be anticipated that only one will cover the losses at the end of the day. Impact underwriting is the way forward in a lot that has to do with such kind of, let's say, considerations, trying to avoid moral hazard from each part of these stakeholders and from the policyholder, but also from the industry. We have issued quite recently, in cooperation with the ECB, a proposal on how one could assess, let's say, could build on PPPs, what we say, let's say, private and public sector cooperation with a ladder of intervention that you would start from, let's say, a part of the perils to be insured. Then you would have the insurance sector playing a crucial role. It is needed. We made an economic analysis together with our ECB colleagues, and we do observe that when, in the absence of insurance coverage, the economic impact is always much harder, interruption in production, and the macroeconomic activity, let's say, being delayed to kickstart again after a major destruction. Obviously, there must be difficulties in extreme tail events when it comes to the capacity of the industry, and then you would perhaps consider how can the state help. and perhaps in a European context, how can Europe help, let's say, in some kind of mechanisms that would alleviate with some perhaps reinsurance mentality there, how you could alleviate the issue. But if I could say it in a nutshell, everyone should keep skin in the game, and everyone has a role to play.
Yeah, so my immediate response also to the your second question is, frankly, in one hyphenated word, public-private partnerships. So, I mean, blended finance comes to mind. Risk pooling, special risk pools, which definitely require some kind of government or municipal backing or support, but to crowd in private capital. Disaster risk financing vehicles. We have a couple of examples in Asia, and I know of many other examples elsewhere. The commonality to all these vehicles and structures is that using public sector resources, reputational support, and maybe even to some extent financial funding to crowd in greater and more funding from the private sector. And insurers do have a key role to play in this because obviously from a perspective, if it's a blended finance vehicle to come in to invest on a particular tranche, so that's where the financing comes in. As an investor, certainly it helps with asset liability management because these are long-term projects and life insurers especially have very long-term horizons. On the liability side, also providing coverage. So this is where non-life insurance providers can also play a role. But so that's sort of my 2 cents worth. But just wondering whether Lotz, Ramon, from your perspectives as investors or as coverage providers, do you see a role for yourselves in some of these vehicles?
Well, if I may, excuse me. I think climate change is not a financial risk. It's far more than just financial stability. It's a global risk that affects all the sectors, all the people worldwide, and it's something that we all need to be together in order to take what are the objectives and what is needed in order to be able to adapt and to change this trend where we are. So whenever a disaster, a natural catastrophe happens, the most important things are the people. The most important thing is that how to recover as soon as possible. What we are seeing is that when the insurer is there, when there is a strong insurance market in that area, then recovery is quicker. And even with less resources from the public. If the private industry is not there, all will be suffered by the public budgets, and the recovery will be much slow. So I think, again, public-private partnerships is, I would say, the only solution where the insurance industry does not have enough capacity to get it. We have to learn together. We have to learn on adaptation and on mitigation. We can go to the market in order to provide more capacities when reinsurance is not enough. But I will say that we need to learn all together because, as I said, this is not just an insurance problem. It's not a financial problem. It's a problem for all sectors, and all sectors have to move together.
Yeah, so thank you. I think I just want to end this panel session with that word, together. So we really need to move together on this very thorny, complex issue. Thank you for your participation as an audience, and certainly to my panelists, both virtually and in person. I want to thank you for your comments and inputs. I think we have more to say than we have time for, unfortunately. And we look forward to further conversations over coffee break with yourselves. Thank you very much.